Hey there, friends! Welcome back to our channel, where we break down complicated financial concepts into simple, easy-to-understand pieces. If you're new here, don't forget to hit that subscribe button and join our growing community. Today, we're diving into a topic that many investors encounter at some point in their journey: capital losses. So, grab a cup of coffee, get comfortable, and let's explore what capital losses are and why they matter. Now, you might be wondering, what exactly are capital losses, and how can they impact your financial health? Let's break it down. To start, let's define capital losses. A capital loss occurs when you sell an asset for less than what you paid for it. This could be anything from stocks and bonds to real estate and collectibles. Essentially, whenever you sell an investment at a lower price than your purchase price, you incur a capital loss. But why should you care about capital losses? Well, they can have significant implications for your taxes and your overall investment strategy. Let's take a closer look. First off, let's talk about the tax implications. In many countries, including the United States, capital losses can be used to offset capital gains. This means that if you have sold some investments at a profit, you can use your capital losses to reduce the amount of tax you owe on those gains. For instance, if you made $5,000 from selling stocks but lost $2,000 on another investment, you would only be taxed on $3,000 of profit. But what happens if your losses exceed your gains? Great question! In that case, the IRS allows you to use your capital losses to offset ordinary income, up to a limit of $3,000 per year for individuals or $1,500 if you're married filing separately. Any losses beyond that can be carried forward to future tax years. Let's say you had a total capital loss of $8,000 in a given year. You could deduct $3,000 from your ordinary income for that year, and then you'd carry the remaining $5,000 loss into the next year. This can be a powerful tool to help minimize your tax bill over time. Now, let's illustrate this concept with a couple of real-life examples. Example 1. You invested in a tech stock, XYZ Corp, at $100 per share. After a year, you decide to sell it for $150, making a capital gain of $50 per share. Now, let's say you also purchased shares of another company, ABC Limited, for $100 each, but you had to sell them for $70 due to poor performance. Here, you have a capital loss of $30 per share. If you sold 10 shares of each, your total capital gain from XYZ would be $500, while your total capital loss from ABC would be $300. So, your net capital gain would be $200. Not too shabby, right? Now, example 2. Let's say you had a rough year and you sold several stocks at a loss. You sold one stock for $1,000 less than you paid and another for $2,000 less. This means you have a total capital loss of $3,000. If you didn't make any gains that year, you can still deduct that loss against your ordinary income, reducing your taxable income for the year. Remember, this can significantly lower your tax bill, which is why it's crucial to keep track of your investments, both the winners and the losers. It's all part of being a savvy investor. To wrap it up, capital losses are an important concept for any investor. They occur when you sell an asset for less than what you paid, and they can be used to offset capital gains or even ordinary income, providing potential tax benefits. By understanding how to manage your capital losses, you can make more informed investment decisions and optimize your financial strategy. If you found today's video helpful, please give it a thumbs up, share it with your friends, and let us know in the comments if you have any questions or topics you'd like us to cover next. And remember, every investor experiences losses. It's how you handle them that counts. Thanks for joining us today, and until next time, happy investing!